Good afternoon. Welcome to Eleving Group Investor Call. We will start with company's presentation and continue with a live Q&A session. To join the discussion, please submit your questions through the Q&A window below the presentation. For your convenience, we will be recording this session and replay will be available shortly after the call. Let me now introduce you to our hosts, Eleving Group CEO Modestas Sudnius and CFO Kreics. The floor is all yours.
Arranging this event. As already introduced, I'm Modestas Sudnius, the CEO of Eleving Group, and it's my pleasure today to walk you through Eleving business plan and also to present an opportunity to invest in our IPO. So let's dive into the presentation. Let's start with quickly describing the Eleving business model. So in short, Eleving is a financial service providing company which focuses on two core products. Main one is vehicle financing, as well as offering consumer loans. And our uniqueness or specialty is that we're focusing primarily on developing markets, frontier markets. So we have operations in 16 markets globally. And also we are very dependent on technology. We try to automate as much of our processes as possible and then kind of offer customers the best customer service. And if you look in the slide, actually we have a very strong Baltic heritage. This is where we have started our business. And up to this day, our main headquarters is in Riga, but also we've grown into other Baltic countries as well. Like we have back offices in Tallinn as well as in Vilnius, and combined our headquarters team is around 250 people. And all of that team is responsible mainly for two things. So developing our IT systems, which are all in-house developed, as well as making sure that operations across the globe, across all of our 16 markets are done at a similar and at a high quality level. So one could expect that we do operate in the market as Kenya, very similar to the market as, let's say, Latvia or Estonia. So this business model allowed us to grow and grow quickly and enter those 16 markets and not only offer our customers financial and mobility services, but as well making sure that we're best in class when it comes to customer service, that we're very diligent in our underwriting and in all the process what we do. So in this slide, you can see our product overview. Our main brand, which is close to half of our portfolio, is still Mogo. This is what we have started. So this is where we're offering customers to finance most common car on the street, which is typically around 10 years old. Already we have more bank-like product in Baltic markets, which goes under Primero, where we're competing with the banking segment as well. And also for some of the returning customers and customers who wants to change cars more often, like we have a more flexible product also in Lithuania and Latvia and the brand Rent. Also interesting product what we have in our African region in Kenya and Uganda. It's so-called Mogo Boda loans. So this is where we're financing motorcycles, but it has a lot of elements of a service actually, because we're financing taxi, cargo, and food delivery drivers who use this motorcycle to generate revenue for themselves. And we provide them not only motorcycle, we provide them all the gear needed to work as a taxi driver, for example, as well as full casco insurance, GPS tracking, and as well we connect these drivers to our tax association network. So that means when they take a loan from us, they at the same time get a workplace. If we move further, then 1/3 of our portfolio is in unsecured lending, in consumer lending, and here I would split two types of products. So in the European part, primarily in Balkans, we're offering typically 1 to 2 year length loans, which are used to buy consumer goods. So mobile phone, consumer electronic goods, mobile phone, it could be laptop, that would be typical purchases. And also this is our sales channels. I'll build that way because we have most of our branches in supermarkets, shopping malls, and similar. And on the African part, we do offer quite a bit of so-called deduction at source products or payroll loans. This is a very Africa-specific product, but here our focus is to work with primarily government employees who we're providing a loan, but actually the monthly payment to us is made by the employer. So it's quite a secured product in itself. And last product is more of an investment. We've been investing in mobility product in car sharing, Tesla car sharing business Oxdrive, which actually just lately we have merged with another first Latvian car sharing platform, Car. So now we're one of the biggest players in that field in Latvia. If we move further and look at some numbers, we've been growing as a company rapidly over the last 12 years, and the last 8 years have been profitable. And we have finished last year with 189 million euros of revenue, 77 million euros of EBITDA, and 24.5 million euros of net profit. This year we have started even stronger, and our net profit for the first 6 months was slightly above 15 million euros. And all of that, of course, is coming from our net loan portfolio, which in the mid-year stands at 342 million euros. So if we just look what we have achieved, so the growth of portfolio over the last 7 years has been on average 26% per year. So basically we've been doubling our business every 3 years. Currently, like, we have already more than 1.3 million customers to whom we have historically issued the loans across the 16 countries where we operate. And of course, we're very dependent also on our sales channels. We have huge network of branches and dealerships across of our markets. Of course, it's very market dependent, but typically we try to cover most of the market through also offline channels. But of course, main channel is still online. And I guess it's not very common in the market, but we also have a Fitch rating, which recently has been upgraded and currently stands at B with stable outlook. If we look at this slide, this is something what really makes us proud. It shows how our company's history have been developing from 2012, one brand, one country, to 2023, when we have 16 markets and 320 million portfolio at the end of last year. And most of the growth happened by us entering new markets. So we already have a good footprint how to do it, like how to analyze the market so that we would succeed it afterwards while entering. Along the way, also worth to mention that at different points in time, we've also acquired two small consumer financing businesses, which two consumer financing groups, which by now are fully integrated in our portfolio, in our businesses. Our technologies are utilized there, and we've managed to grow them successfully as part of Eleving Group. And now we're standing at very exciting times for the company, because we see that we have a potential to double the business again, or close to double the business again until 2026. And that's actually the main reason why we are doing this IPO, because we see that, of course, from already higher base, doubling the business again, like, you need a bit extra equity for that as well. So we'll talk about that a bit later. In this slide, you can see our geographical split of markets. So 55% of our loan portfolio is in continental Europe, 32% is in Africa, and 13% is in remaining part of the world, which is Caucasus and Uzbekistan. And of course, in the map, you can see quite a few, let's say, developing markets. You could even say exotic markets. But what's worth to mention that if you look at portfolio split, actually, in typical market, we have 5 to 10% of overall net loan portfolio, and that's our sweet spot. So we don't want to build a too high dependency on one or few markets, because we do, of course, acknowledge that working in developing markets, there might be a bit more turbulences in one year or the other, and having this risk diversification per market allows us to really control the overall group's performance very well. And we can just look at the history. For example, 3 years ago we also had a business in Ukraine, which unfortunately we had to write off a few years ago. But nonetheless, even though if it has happened and then we lost some money in that market, but as a group we still had an outstanding year. So we're very diligent and careful while choosing the market, but also we're very diligent in kind of growing the market. So this is the strategy also what we see going forward, to maintain this geographical diversification in between the markets. And if we move forward and a few words about our technology, maybe let's start with some numbers for you to understand what's the scale of the business and the number of applications we are working with. So if we look back last 12 months, we have received slightly above 1.4 million of applications, and these are already, let's say, fully filled applications, which allowed us to score the customers. And actually our conversion rates, they were rather low, I would say, rather conservative. So on vehicle finance side, it was just below 10%, and on consumer finance side, it was 1/3. First of all, why the difference? So on vehicle finance side, of course, tickets are bigger, liability is bigger, so entry barrier is bigger, and at the same time we also need to evaluate the vehicle. On consumer finance also, since the tickets are smaller, loans are of shorter maturity, already now we have a very loyal customer database, and more of half of the issuances, more of half of the leads are repeated. That means repeated business is always the most profitable for a business. That's why this conversion rate is also way higher. And of course, identifying whom to issue a loan and for what pricing, what conditions, that's our core competence. So first of all, what's very important for us is to collect all possible data about the customers. So in European Union markets, we already have very good databases available, credit bureaus, income databases, but we're also trying to use some of alternative data sources. So in same African region, we're using a lot of mobile wallets, which provides very good data about customer spendings and income. We also use different anti-fraud tools, and all of that data provides us a lot of data points. And on top of that, when it comes to vehicle financing, we're also evaluating the vehicle. So from the VIN code, we can get all the details about the vehicle history, and at the same time, we're also building a tool how we identify average value in the market. We're using some information which we're getting from biggest car portals, because in reality, there's no very good databases available. And then we're identifying the average market price of these vehicles. And, we put all that data into our underwriting systems, into our scoring models. They are developed by us, but let's say we chose to use Microsoft Azure services, so it just allows us to use some of up-to-date, technological advancements, and then things as machine learning and things we've been using already for multiple years. It just allows us to create risk models quicker, update them quicker, and as a result of that, with no human interaction in making a lending decision. Humans, of course, in many cases helps us, our employees helps us to collect all the necessary data, but once that's done, system fully makes a decision automatically, and that allows us to offer an answer and then provide an offer to the customer within a few minutes in most of the cases, and that's a strong competitive advantage in the market. Now a few words also about our sales channels. So worth to mention that we're not only online, we're both online and offline player. As already mentioned, we have multiple digital channels. starting with our product web pages, we even have our small car classifieds in each of the markets. So of course, it can't compete with auto Plius, but still we have thousands of cars, and through social media we can really advertise some of the cars which our customers has returned, at the same time also our best dealers' cars. So around 60, slightly more % of all the leads comes through online. But quite a big part, especially in some of the developing markets, also coming through offline. So we have 274 branches. Worth to mention that, it sounds maybe like a lot, but in Baltics, let's say, we have very few branches, 1 or 2 branches per country. That's not needed. It's already very kind of digital economy. But at the same time, in more cash economies, like I know Albania, for example, so we could have even 30 or 40 branches, but often this is not very admin heavy, because branch can be just a table in a shopping mall. And also worth to mention that we have a strong dealership network. So we have more than 1,300 dealerships, which in last 12 months brought us at least one lead through whom we have issued a loan. So most of these dealerships have brought us 10 or even 100 or 1,000 leads. So this is a very strong partnership. We're providing our IT systems to those dealerships so that they could submit any information and receive all the necessary documents very quickly and conveniently. And at the same time, of course, they really appreciate that they can sell more cars using our help. And for us, that's a best partner. So I would say very diversified sales channels, what Eleving Group has in its markets. Now handing over to you, Mare.
Thank you. So moving on with the management team. So here on this slide, you see key employees of our group. Altogether, we employ close to 3,000 of employees across all the markets where we operate, from 20 and more different nationalities. Apart from management board, we have also recently established supervisory board. So the chairman of the supervisory board, Marcis, he's actually one of the initial co-founders of the company. He was with the company for the first 2 to 3 years of its existence. Together with him, we have 2 independent directors. So we have Derek, whose background is in private equity and venture capital, and Lev, who's actually an active investor himself, and he's one of the thought leaders in the investors community, especially in Estonia. If we move on to financial highlights, I suggest to start with the top on the left. So here we have our revenue development over the last 3 full years. Here you can see a consistent growth year over year that correlates with the growth of the business in general and the growth of net loan portfolio. However, it is worth to pinpoint out the achievements for this year. For the first 6 months of this year, we managed to record more than 100 million of total revenue, which is actually 20% more than it was in the equal period in the last year. If we look at the EBITDA and net profit, so here we see a similar dynamics. For the first 6 months of this year, we managed to achieve 44 million of EBITDA, which is close to 30% higher result than it was in the equal period last year. And lastly, on net profit, so here we also have a growth for the first 6 months of this year, where we achieved 15.4 million euros, which is 25% more than the year before. Key story here is that our profitability is growing at a faster pace than the revenue. So that means that we are able to build more business on our existing cost base, and also our portfolio quality remains high. On the lower hand of the slide, you see 3 financial metrics. These are actually 3 financial covenants that are present in all of our Eurobonds. As a reminder, we have currently 3 Eurobonds outstanding. One of them is subordinated. The other 2 are 150 and 50 million Eurobonds. So these financial covenants are present in each of one of them. So if we start with the interest coverage ratio, here the higher the ratio, the better. And here we have 2.4 times of EBITDA over interest expenses. So that's one of the highest results that we have managed to achieve historically, and that's almost 2 times higher than the minimal level required by the financial covenant. Moving on net leverage, here in contrast to the interest coverage ratio, here the ratio, the lower the better, and we have 3.3 times versus 6 times. That's the maximum allowed level as per the financial covenant. And lastly, on the capitalization, we're consistently operating with a relatively high capitalization ratio. That's equity over total net loan portfolio. And here we are at 26% as of end of June of this year versus minimal required level of 15%. Continuing on, so here it's worth to mention that we have been present in the Baltic and actually European capital markets since 2014, once the very first bond was issued by our company. And similarly, with the Mintos Marketplace for Loans platform, we were one of the first loan originators to be onboarded in the platform, and that happened in year 2015. So throughout all these 10 or close to 10 years of our presence in both of these venues, we have managed to pay out our investors more than 140 million euros just in interest alone. And here we are not accounting repaid loans, repaid bonds, just the pure interest. And of course, we have built a very wide retail investors following, where across all these platforms, be it bonds or Mintos Marketplace for Loans, we have more than 20,000 different retail investors that are constantly investing in us. And lastly, we as a company, up to the last year, we have been always reinvesting profits back into our business. However, in year 2023, we paid our very first dividend, and we continue to do so also in the year 2024. And in these last 2 years, we have returned to our shareholders more than 15 million euros of total dividend. This is also an important aspect going forward because we anticipate to be a dividend-paying company, with dividends being paid on a semi-annual basis, with a target dividend payout ratio 50% and more from annual profits. Moving on our approach of ESG. So if we start with environment first, our company's mission since day one has always been to finance the mainstream vehicle that drives on the streets of the markets where we operate. And for instance, in Europe, that is actually 9 to 10 years old vehicle. However, we see that as an opportunity to drive the push towards sustainable mobility further, and that's why we have several products implemented across the markets where we operate, where we offer our customers products with better terms if they choose to choose vehicles like hybrid or electric ones. And of course, our initiatives such as e-motorcycle financing in African markets, where we aim to finance more than 40,000 of electric motorcycles by 2028, fits perfectly in this strategy. If we look at the ESG approach from the social aspect here, again, we can look at it from portfolio or customer's perspective. So we are really interested in having a long-term relationship with our customers, not putting them in distressed situations. And that's why we have created several online tools in most of the markets where we operate, where our potential and new customers and existing customers, they can check their credit worthiness, for example. They can do a quick financial check. And generally, they can read throughout what it means to have a loan and how to work with the loan in general. Lastly, on the governance aspect, since the very first Eurobond that we issued in the middle of 2018, we have been reporting consistently on a quarterly basis to our stakeholders. If you would go to our webpage, you would find more than 20 quarterly reports where we are reporting to our bondholders and other debt investors on our progress, on the strategy, and how we are executing it. And all this effort has been positively also assessed by, for instance, Nasdaq Baltic, where we actually received an award for Best Investor Relations in Nasdaq Baltic bond list. Moving on, here we have our financial targets for the next 3 years. If we look at the net loan portfolio, you'll notice that our aim by end of 2026 is to exceed the net loan portfolio, exceed 500 million euros mark. If you look at the growth, annual growth here, so we're looking at something that's close to 20% growth per annum. And looking historically, that is actually something that we believe is quite doable because our historical growth rate up to this point over the last 7-8 years has been 26%, as explained by Modestas previously. Our revenue is expected to grow together with the net loan portfolio at a similar pace of 15 to 20% annual growth. At the same time, our net profit is expected to exceed 50 million euro mark by end of 2026. And you'll notice here that we expect improvements in the profitability to outpace the growth in the overall business, because these are these direct platform effects where we're building more and larger business on the existing cost base, on the existing infrastructure. And also a quick reminder here on the dividend payout ratio, which we intend to have 50% and more from annual profits starting this year and onwards.
Thank you, Mario. So in this slide, I'll try to summarize like the three core growth pillars. So first of all, if we think, and we do think in 3 years increments, if you think about next 3 years up until 2026, so biggest part of the growth will still come in from the organic growth, because we already have a platform in 16 markets. We have not, let's say, we have not used full potential of those markets. Those markets' economies are growing now, populations are growing, so there's still quite a bit of growth left there. So some 10 to 15%, closer to 15% will come just from that. And as Marius already mentioned, this is typically the most profitable growth. At the same time, we're also looking to launch more new products in the same existing market. So at the same time, also on the same base, same cost base. So already mentioned the electric motorcycle rolling out, because we're already issuing like hundreds of electric motorcycles, financing hundreds of electric motorcycles per month, but we see that in the future it should be thousands. And at the same time, we are looking at SME financing, wider SME financing opportunities in some of our European Union markets. Let's say Romania could be a great example where we see quite a big niche. And then so far we work with a very tiny segment with SMEs, so SMEs who want to buy a used vehicle, but actually we see that we could go into slightly higher tickets and do it kind of collateralized loans, whether it's agricultural machinery, whether it's factoring type of services. Of course, lower pricing, bigger tickets, but at the same time, even more secured products. So this is something what we're working on this year in terms of business case, market analysis, with a plan to start launching these products already next year. And at the same time, we have a track record of launching new markets, and then we're definitely going to get back to that. Again, this year, that's a preparation year, and starting post-IPO, starting 2025, we do expect that typically at least one new market per year we're going to launch. But of course, fair to say, if we look just on midterm strategy, it takes some time for the new market to get to this really serious growth stage. So first 2 years growth is a bit more conservative. We still need to test our underwriting models, see how the business model works, and etc. But so that's more an investment into like more long-term future. And if I could finalize our story and our let's say IPO pitch, typically there's like economists saying that there's two types of companies: value company, which is a bit more mature company and which can provide returns in form of dividends, and then growth, which still has a kind of quite a big potential to grow further in revenue, in value, and similar. We do see that still we fit both categories quite well. So from one angle, like we're already, we're 12 years in the market, last 8 years profitable. We have established governance structure. We already have a track record of dividends. So we have quite a bit of elements, and then I would say it's even almost like a downside protection as investing in a share, because you can expect stable returns in forms of dividends. But at the same time, we've been building our business all along for growth. Firstly, like we have a diversified borrowing structure, which limits the risk, and also in the future it will allow us to borrow more and then borrow from diversified funding channels. Also, when it comes to our competitive advantages and then our already mentioned hub structure and NAT, so it's already in place. Like it's very easy to launch new market, to clone the system what's being used, and of course worth to look at the markets where we operate. Most of them are growing economies, growing number of people, so it's just a natural growth opportunity there. And at the same time, how we look at this IPO and maybe how we've been building this company, that it's kind of a Baltic company which actually does a global business, and then we do think that this could be very attractive for investors, and it's for sure works for us from a business perspective when we have this operational control from Baltics and we can really utilize Baltic talent to the best. So now handing over again for IPO summary.
Thanks. All right, so here's a slide on IPO summary. If we start with the most important thing, that's price per share. You'll see that we operate currently with a range, and that range currently is from 1.6 euros to 1.85 euros per one share. We expect that range to be narrowed down as we move closer to the end of subscription period, but currently this is where we started. Importantly, our investors will be able to subscribe starting with one share already. So all in all, quite an affordable security if you look from that perspective. This price per share, if multiplied by the number of shares outstanding, would give a company's valuation in the range of 160 million to 185 million euros before IPO. The transaction amount is up to 40 million euros that we are looking to raise. Importantly, first 30 million would actually be new capital, new shares issued, with the proceeds remaining with the company itself. We also have an upsize option of additionally 10 million euros, that in a case of favorable book building process and large investors' interest, we could potentially use this option to sell from the current shareholders proportionately. Altogether, so if both options used together, we would be issuing up to close to 25 million of new shares. Actually 19 million of new shares, and 6 of that would be selling the current shares. On the use of proceeds in the midterm, as described also before by Modestas, so first and foremost, that would enhance our investments in the current portfolio growth. And of course, we'd be looking to launch new products and new markets. However, in a very short term, not to kind of park that raised proceeds on those 30 million in the balance sheet without any use, we actually intend to use these proceeds to repay the most expensive part of the debt that we have currently in our capital structure, and namely those would be subordinated bonds and also other avenues of debt, which are actually the most expensive ones. On the dividend policy, we touched upon this already before, but a reminder, we're looking for dividends to be paid out in the range of 50% and more from annual profits, with the dividends distributed on semi-annual basis. Important aspect would be on lockup. So we have a 24 months lockup for majority shareholders, who would be close to 90% of the total current shareholders base. This is actually longer than it is customary for IPOs. Usually this would be 12 months. But since we are very much focused on the healthy price development post-IPO, this we believe is something that will strengthen our relationship with the new shareholders. We intend our shares to be listed in Nasdaq Riga Stock Exchange, as well as in Frankfurt Stock Exchange. And this, why we have this dual listing? We have this dual listing because of our successful track record with the bonds, where all our current bonds are also trading in both of these exchanges. And lastly, on the subscription period, it has basically started this week on Monday and will last until October 8th, which will be Tuesday. And of course, our suggestion would be not to leave it until the very last day in case there's any technical difficulties to subscribe to the shares. On the key question, how to subscribe to the shares. So we would invite our potential shareholders to approach their current banks. In most of the banks in the Baltics, the functionality is already live. Also in our webpage, you can follow specific instructions how to subscribe to our shares per every single bank. We have most information already there. But in case if you don't have an account or any investors are facing some technical difficulties, you can also approach our investor relations department. Lastly, once again, subscription period started this week, will last until October 8th. And for more information, we invite our potential shareholders visit our webpage dedicated for this IPO process specifically. Thank you.
Thank you for the presentation. We're now opening a Q&A session. To join the discussion, please submit your questions through the Q&A box. They can be submitted either anonymously or with your name. The first question in line: how will the IPO impact the cost of capital for the group?
Yeah, so this is quite an important aspect of the IPO as such. We expect with the new IPO proceeds, company to be recapitalized, meaning that our equity versus total assets or leverage would improve. And with these improvements in the capitalization, we actually expect that we should be able to have a discussion with our rating agency on potential rating upgrade. If that happens, that of course will impact our borrowing ability and cost of borrowing favorably. As of this moment, we would not give any specific targets for our cost of capital, but in the mid and long term, we will definitely see our ability to borrow to actually improve.
What is your long-term plan for the African market?
Sure. So currently, like if we look currently, African market is slightly above 30% of overall net loan portfolio, and of course we do see that there is quite a big potential to grow there, and you know, just the population itself, like same Kenya and Uganda, each has more than 30 million of citizens, kind of two our biggest markets. But so we see that we're gonna grow there. We would also consider launching one or a few more markets where we would also be offering primarily productive lending while financing these productive assets, which are like motorcycles or taxi cars used for taxi services. But at the same time, we don't want Africa to significantly outgrow our other parts of the business. So we do see that Africa most likely in 3 to 4 years horizon would get up to probably around 40% of overall net loan portfolio, but still 50% range should stay and will stay in the European part of the business.
Thank you. On the same topic, who are your main competitors in African states?
Yeah, so actually, maybe strangely enough, our competition in Africa is, I would say, the most clearly seen, and was quite a big players, quite a few players which are working on Pan-African level. Some of them are even listed companies, which probably that they are not that well known in Baltics, but that could be Platinum Credit, Lechego. So they have more than, let's say, Platinum Credit has more than 1 billion euros of portfolio in Kenya, so way bigger business than ours. But what's good, and so far, kind of, it has been so far quite easy to take a market share from these businesses because they are non-bank lenders. They do operate in the market for quite a long time, but their pricing is higher than ours, but they still operate on this banking sector mentality. So they're very bureaucratic, they're quite slow, not that data driven, or more, there's still like some human interaction in this credit decisions and so on. So far it has been quite easy to gain this market share, and we're quite proud that we have this competitive advantage in those markets.
Thank you. What is more important to you, growth or profit?
This is, of course, a good question. I guess we need to look from two aspects. So one, even before an IPO, so we're a company which is borrowing a lot in capital markets, and if we would have distressed years, and if we would have a loss-making year or a very low profitability year, that puts a stress to our debt as well, because we constantly also need to borrow. So actually having very strong fundamentals and financial performance, that's a key to business as ours. And at the same time, if we would already be thinking about a public company post-IPO, so as Marius already mentioned, like price development is of course also very important for us. We want to have a healthy stock, a growing stock, and in our opinion that still in these days weight of profitability outweighs the, let's say, growth. So our core mission is to accomplish both, but if we see some turbulences along the way in the results, then most likely we need to slightly slow down the growth and then improve the profitability, because growing while putting a stress to some of our financial covenants and financial ratios and financial performance, that would just not be healthy and would affect both possibility to borrow and then share price.
Will you also be paying dividends, and if yes, then how often will they be paid?
Yeah, I believe this question was covered during our presentation, but as a reminder, we plan to pay dividends 2 times per year. First time after announcing and publishing annual report, and then the second time would happen 6 months later.
On the same topic, will the first dividend payout for new shareholders be in 2025 or the second half of 2024?
Yes, so the first payout is expected to happen in the first half of year 2025, after approving and publishing our annual report for year 2024.
Thank you. Continuing with the online questions, what part of the 342 million net portfolio is performing and what part is non-performing? Do you divest non-performing loans?
Mm-hmm. Sure. So I'll split the answer in 2 parts. So let's say first on the non-performing loans, or NPLs. On the vehicle business segment, we have less than 8% of NPLs in our net loan portfolio, and on the consumer business segment, we have less than 5% of NPLs. And yes, although we do tend to do a full end-to-end debt collection ourselves in-house, and that's one of our competitive advantages as well, we also employ a strategy of selling or divesting NPLs if that case is available, or if that makes economic sense for us.
Thank you. How do you see the evolution of interest cost in percentage of gross revenue? And how do you compare this with other players? And what are you planning to do to keep this in control as a non-bank?
Mm-hmm. All right, so I think it's worth to mention that we largely borrow at fixed interest rates. So most of our Eurobonds, and actually 2 of our largest Eurobonds, are fixed rate, fixed coupon bonds. Also in the Mintos platform, we offer loans with fixed rates. So let's say generally our interest costs are more or less fixed, and they do not tend to fluctuate. In the long term, we expect our interest expense versus revenue, actually the proportion, to go down due to the fact that we already mentioned before, with a recapitalized company and hopefully also improved credit ratings sometime down the road, we should be able to get that interest costs down versus the total revenue. How we compare with other non-bank lenders, or let's say indirect or direct competitors, Generally, we believe that our cost of borrowing is slightly bit lower, and that is because of the perceived less riskiness of our business, because we are largely secured lending company. We have asset base, which is our net loan portfolio, which is actually backed by the real assets, meaning vehicles. And in this instance, we are getting the benefit from the bondholders' perspective, and let's say we're able to borrow at a slightly lower rate than any other indirect or direct competitors.
Thank you. Seems your success is very much dependent on your origination of leads, online and offline. What is the marketing and sales branch cost in percentage of gross revenue? And how do you expect this to evolve and why?
Sure. So of course, as for every company to issue or to sell, like you need leads. So we have quite wide range variety of sales channels, both online and offline. And actually we track a little bit differently, like our costs. So when we look at marketing costs, we actually look costs per issuance. So what part of, let's say if we issue 1 million euros worth of loans that month, how much did it cost to generate that 1 million euros? And we have this golden rule. Actually, we have it for last 10 years that not to go above 3%. That means our marketing cost should not be above 3% per market per our sales kind of sales volume, and we've been very successful keeping within 2 and 3% range, and then that takes everything into account. That takes dealership costs, meaning fees what we pay to dealers, but we are paid only on success basis. That all the digital AdWords like Google AdWords type of expenses, Facebook, and at the same time even organic offline expenses such as print, TV, and so on. So we're keeping within those kind of borders, and at the same time, like we're quite well-known brand already in quite a few markets. So we're getting quite a lot of organic traffic, which is cheap. And if you would look, and I think in our quarterly presentation we have showed it, if you look at the last 12 months, our number of applications grew almost by 50%, even though our marketing costs stayed pretty much flat. That just shows that demand for a product is high, and we do see that there's quite a bit of potential because, as already mentioned, competition is not that strong, and we also see that some of the banking segment customers were coming to us because banks in recent years became even more strict for certain segments. So that's quite well in control. And when it comes to costs, so we typically look at cost to income ratio. Here, I believe, Mari, now we're at 37 to 38%, which is a good level, but our long-term projection is to go down to around 35%, which again would indicate that we need less admin costs for growth, less extra admin costs for growth, and that should add up to overall profitability.
Thank you. Seems your organization is quite big with 2,800 full-time employees. What is the fixed cost as percentage of gross revenue, and how do you expect this to change as you grow? And a follow-up question on the topic, do you expect the organization to grow in line with the portfolio size?
All right, on the costs, I think it's worth to mention that we have three largest cost items in our profit and loss statement. So firstly, that's borrowing costs. Secondly, that's cost of risk or impairment expense. And last one would be admin or operational expenses. So I would say that impairment expense as well as cost of borrowing, those would be considered variable costs because they would tend to fluctuate together with the size of the business. As we grow the business, they would increase. As we shrink the business or net loan portfolio, for whatever the case that might be, those costs are also would be going down in absolute terms. So lastly, also as Modestas mentioned, cost-to-income ratio, so 35%. So these would be these OPEX costs versus total revenue. So let's say in those, these would be kind of 1/3 of the total cost that would have some fixed cost element in them. But worth to mention that half of those 35% from total revenue costs would be related to employee expenses. So to some extent, that could also be considered a variable cost, which would fluctuate together with the size of the business. So if we kind of digest all these line items in details, we're not left with too many of the actually fixed costs per se. So the only items would be things like our office expenses, maybe our IT systems amortization, which is already money spent and then amortizing over the multiple of years. So all in all, we believe that the costs, as in the absolute terms, they would definitely grow together with the size of the business. However, also as it can be seen in our profitability long-term targets, where we see profitability improving in relation to the revenue, basically we expect efficiency improvements along the way, meaning that the cost of kind of revenue growth would actually outpace the growth of costs.
Thank you. What is the reason to go public? Can you please remind on the use of proceeds from the IPO?
Sure. So here I'll remind what we just presented. So the reason to go public and to raise fresh capital is to support the growth. We do want to close to double the business in the next 3 years. And to do that effectively and to do that, not putting any stress and even strengthening the company, that's the main reason for doing an IPO. And the use of proceeds, let's say midterm, would be for the growth. Short term, not to sit on the cash, we would be covering some of most expensive liabilities, which would give additional boost of profitability in the short term. And afterwards, we would be tapping back into those debt markets, debt sources, and growing back portfolio using that.
Mm-hmm. Thank you. We have received a question on the shareholder structure. Can you explain the current shareholder structure and how will the IPO impact your governance and independence from affiliated companies of your shareholders going forward?
Sure. So our, let's say, Luxembourg level shareholder structure looks like that around 87% of the company is owned by 4 Latvian individuals, businessmen who actually established the company. They never managed it, but they are the founders and they gave all the initial capital needed to develop the business. So they've been owners of the company, majority owners from day one, and they stayed it. And the remaining 13% approximately belongs to current management, former management, primarily. So these are people who got those shares through different share option schemes and similar. And currently already the company is managed full independent from the shareholders. So there's a professional management board of which we are part of, and also mid this year, I believe, we've established a supervisory board of 3 members. 2 of them are independent and who supervises the management board kind of strategy and similar things. And going forward, we don't see that we need dramatic changes. Maybe in the future, it could be considered that the board would grow, the supervisory board. And when it comes to affiliated companies, to be honest, I guess probably it's being referred to Mintos platform with whom we are cooperating. So they do have some of the overlapping shareholders, but at the same time, these are companies run fully independently and there's no overlap. So we're, I would say, both Mintos is also regulated by Latvian Central Bank. So it was like nothing should change in the relationship as well.
Thank you. What do you think about partnerships with ride-hailing companies such as Uber and Bolt? Your board member, Derek Urban, has been involved with Move, which is now valued at $1+ billion thanks to its partnership with Uber in Africa and the Middle East.
Sure, very good questions and good homework then here. So we do evaluate those partnerships, and actually we had some projects, small projects, test projects, what we had in both in our African market. It maybe did not fully utilize as focus of the companies at that time slightly changed, but already indirectly we kind of partner with those companies because some of the vehicles which we finance are used to work on those platforms, and then same taxi services are provided using those apps, and that's one of the option because there's also even other platforms which operate in other markets where this, let's say, more fleet management is a good collaboration tool for ride-hailing companies. So far, we're not focused on fleet management because we're focused on individual financing, and for that, these partnerships were not that needed. Typically, customers finds each other, like our customers finds Bolt, and then vice versa rather easily. But we don't disregard that could be an interesting growth opportunity where we would go slightly into more operational business and consider fleet management. And in some markets, actually, it could be even a better business case to ours. So it's not a part of our business plan, but that's probably something what we will take a look at in the future. And Derek, of course, having a person as Derek in the board, that's very advantageous because he knows how this business is done. He has all the contacts, all the necessary relationships, and at the same time he actually knows how business works in these developing markets, because his experience comes not only from African markets but also from Central Asia markets, which everywhere we do operate, and there's very few people, I would say, maybe not in the world, but at least in Europe, who has this type of experience.
Thank you. Why is Eleving so successful when Planet 42 has flamed out?
Yeah, that's, I guess, we were expecting similar question. And here I'll try to comment, maybe not going too much into details into Planet 42 operations, because fair to say we don't know some more insights to the general public, but we need to distinguish a few things. That business models are completely different. Planet 42 was, or I guess still is, was doing rental services of used vehicles. We're providing financing services, and then was very fundamental differences here. So one thing, just even from customer underwriting perspective, let's say in same Kenya, where we're financing cars as well, this is actually a very big purchase for Kenyan population. So we're financing upper middle class, because car costs 5,000 to 6,000 euros, and that's huge amount for Africa, because motorcycles will cost around 1,000 euros, and in our case, customer already needs to bring, in most of the cases, around 40% down payment. So our customer skin in the game is already very significant, and of course afterwards customer gets a financial product, so he's responsible for the loan till the end. He's responsible for the vehicle. He can't terminate a loan. Like, the only way how you separate, it's either a default, but then you spoil your credit history, or and you give away the car, which you already kind of invested a lot of your own money, or you make an early repayment. While to our understanding in Planet 42 business case, it was that you have quite a lot of flexibility to return the vehicle, and at the end of the day, vehicle is more company's responsibility. So that puts a huge operational burden, and at least from our point of view, okay, we have not succeeded maybe of some other reasons, but business model itself, it's very hard. I think it's very hard to do it everywhere in the world. It probably is even harder to do in African region, because roads are of worse quality, and then maybe some of the car prices, you need to be really careful how you identify. And then if you're getting into car repair business, then I think that's another layer of complexity. So we actually ourselves evaluated the potential to go into South African market, but regulatory environment for financial companies is very unfavorable there. It's built only for banks. The maximum interest rate, I believe, what you can charge is around 24%, which was very similar to Planet 42's cost of financing. So this is just not the right market for us, and business model, we believe, is just very, very complicated. And I guess at the end of the day, track record speaks for itself. We've been, as a group, profitable last 8 years, and then we've been, in African markets, we've already multiple years profitable across different countries. While I guess Planet 42 was always loss-making and then still at this startup level. So at the end of the day, it's just two different business models and two different kind of maturity type of companies.
Thank you. How volatile do you expect your net profit per share to be?
Yeah, I guess it's very hard to give any future estimates or any guidance on the actual profitability volatility. Of course, there are multiple factors built in our P&L that we don't fully control, or we control to limited extent. However, I would suggest to look at the past historical track record here, and specifically over the last 2 years, let's say full years, the year 23, year 22. So these would, I would say, would be the best indicators of where the group roughly stands currently, and how we would perform also going forward down the road. Before those years, which I mentioned, we had different phases. We had a growth phase within the company. We had a phase where we were stabilizing ourselves. But let's say for the last 2 years, it's a fair estimation or fair proxy of our operations, how we expect those to be in a mid and longer term.
Can you explain why would capitalization get better when you replace the subordinated debt, which you count to equity?
Sure. So subordinated debt currently in our balance sheet is in the range of 12 million euros, while the IPO proceeds, as discussed before, we're looking to raise 30 million in primary proceeds. So effectively, that means paying down 12 million, but onboarding 30 million instead. So of course, in absolute terms, that improves the equity, and also equity versus total assets as well. And on top of that, there's also a secondary effect that will come out and play itself out on a month-to-month basis afterwards, because what we're doing is we're replacing the subordinated debt, for which we are paying one of the highest interest rates, with a capital that carries no interest rate.
Thank you. The recent IPO of another growing Latvian fintech company, Eleving Group, shows a share price drop of more than 30% so far. What sets you apart from a similar fate?
Sure. So first of all, we do acknowledge that we have some of overlapping shareholders with Eleving Group, but as a companies and as a business model, we believe this is very different type of companies. Eleving Group, as you already mentioned, it's purely Latvian company. Actually, we don't compete even on a product level in Latvia, where we're focusing only on vehicle financing. And we're way more international company. Close to 90% of all our revenues comes from outside Baltics, and we have completely different platform, different growth opportunities, and at the same time, of course, we were following Delfin IPO. So how we value our company, we're looking at their current performance. So we believe that all the future upside that's not priced in the current company's price, and then I guess our track record shows that we're capable in demonstrating solid growth. So we do think that many things sets apart us from Eleving Group, and essentially I think we should probably be compared to slightly different type of companies and different industries.
Can you please provide your return on equity targets?
Yes. So immediately post IPO and on the years onwards, we expect our return on equity to be in the range of 25 to 30%.
Thank you. Please talk in more detail what would be the process of leaving the market in case of some unexpected difficulties. As an example, how you left Ukraine. Was it a total loss for you?
Sure. By now I can say that we know very well not only how to enter the market but how to leave the market, because it's not only Ukraine, but there's been multiple other markets where sometimes our business case did not work out. So in case of Ukraine, we're still collecting last payments, but our net loan portfolio is already only a few €100,000 left, and I think at the highest point just before the war breakdown, we were around €5 million. So it wasn't a total loss, but we had to write down close to half of a portfolio, because in quite a few regions where we had loans issued, of course we were affected by war, but some of the regions still some population was paying. So I think Ukraine is maybe extreme example because of the war, but in I don't know, in markets which we ended. Okay, maybe I'll give you even an example. Like we unfortunately also had a business in Belarus, which we had to exit, but it wasn't that easy to exit Belarus. And let's say at the peak, we even had around €20 million of net loan portfolio. But once, of course, all the madness started happening, then we were trying to sell the business, but it took us almost 2 years, actually not to find a buyer, but to get all the approvals. But what we saw in those 2 years, when we stopped issuing loans, actually it was still profitable operations, because all the impairments were front-loaded, and then you still have a solid revenue, which kind of generates you income. Then you decrease your cost to minimum, because you need pretty much only debt collection team. So it was a successful rundown until a certain stage, and then we actually got an approval to sell it, and then we sold it for book value of equity. So it was a P&L neutral transaction. So worth to say that in most of the cases, exit is not too expensive and can be even profitable, just because of the impairment policies what we use, and because the most work has to be done with a new portfolio, because most of the defaults happen in first few months. You need to book impairment in first few months, and then of course you need sales channels. Once that's eliminated, to maintain a portfolio, even in a rundown market, you don't need like a lot of admin costs.
Thank you. Do you consider secondary share offering in the nearest future?
We don't consider, and I guess our strict lockup of 24 months indicate that best. So we're a growth company, and then already a strong dividend paying company. So that's a good story to existing shareholders as well. Like then you can achieve both factors.
How do you account for cost of risk? Are you using IFRS 9? Can you give some insight on the rules you follow?
Yeah, all right. So we're using IFRS 9, since we're reporting under the IFRS, and we have been doing that already for more than 10 years now. And we have been applying IFRS 9 since 2018 already. What it means in practice is actually that once we issue a loan, say today, we immediately will make a provision for that loan, even if the loan is not overdue, even if it still is a current loan. There will be several percentage points that we would immediately apply a provision towards it. And of course, as the loan moves through different stages of its life cycle, the amount of provision would change. But of course, I would invite to read all the full IFRS 9 policy in our annual report, which is very detailed, described in details there. And lastly, I wanted to also mention that we have been audited by Big 4, Big 5 audit companies already since 2013. So of course, our application of IFRS standards is being diligently checked every single year.
Thank you, Mar. In which market is your portfolio growing the quickest? Which market is the best in sense of earnings margin?
Very good question. And actually, like in the following room, we have a screen for our teams where we show sales per month in different markets, and there's quite a bit of competition, to be honest, and maybe something what has grown very quick last year, not necessarily growing at the same level this year. But market which definitely has the biggest growth potential and has been demonstrating it, let's say, over last 6-12 months. So on a vehicle side, I would mention Romania. I would also mention Uganda, and I would mention most likely Georgia. So all of these markets are demonstrating strong double-digit, close to 20%, and it seems that there's still quite a lot of potential there. In terms of earnings, again, our revenue per portfolio is slightly higher in consumer and finance businesses. Of course, provision expenses are also higher there, but market as Albania has been demonstrating exceptional results. Also already mentioned Uganda showed very good results. Our maybe new up-and-coming star on African region is in consumer lending, also Namibia, which we just acquired mid last year, but it already shows very good performance. And Lithuania has been always stably strong. Estonia probably slightly more margins because pricings, of course, are lower, and then portfolio is quite small. Latvia is somewhere in the middle. And probably I would also still add also Armenia, where we see that their economies are doing very well and our portfolios are growing, so profitability is quite high there as well. But overall, we have, let's say, last year we have earned close to 25 million euros of net profit, and 14 out of 16 markets were profitable. So it's quite split, these earnings between the market.
Thank you. 2 more questions to go. How many African markets you operate in have a cap on maximum interest rate you can charge customers? Do you see risk of ceiling being lowered, and how can you defend your profitability against it?
Sure. So currently we operate in 6 African markets. That's including Lesotho, where we don't do much business. So you could say in 5. Interest rate cap we have in 3 of those markets, I believe. But it can be, sometimes it's an APR cap, sometimes it's costs you can charge to customers. But we are regulated in every single market in Africa. That means there's quite a strict regulatory environment with a regulator, which is typically central bank and so on. And of course, margins are higher compared to European part, but I think maybe some people think that they are like way higher, but actually it's not necessarily the case. In the same Botswana, we're charging 50 to 60% APR, which is of course on the higher end, but this is very normal rate for African region, and then we have competitors who are charging way higher. So in this, looking from banking to non-banking, we're somewhere in the middle, and then we welcome these regulations because that says just a more clear framework. And on top of that, in the longer run, we do see that we do want to work more and more with repeating customers. And for repeating customers, you can offer lower pricing because you already are quite confident about their performance. At the same time, you can offer them longer tickets, bigger tickets, longer maturity. So very good example, which probably is a kind of population with lowest credit scores, which we're financing. So already mentioned taxi drivers, but quite a few of them take a motorcycle loan for 1.5 or 2 years. They repay it and then they come back for next one because maybe then they want to do almost like a business. So of course, next loan is significantly cheaper for them, and then their performance is outstanding. So we have many ways how to tackle that, but I think so far we're in very comfortable position in this whole lending space and in this pricing range, because we're definitely like not at the top.
Thank you. And the last question, how do I reconcile targets of doubling the business and a 50% dividend payout?
I think here it's worth to mention that the portfolio growth from the current close to 350 million euros to 520 million in 2026 would not and is not expected to come from equity alone. So we expect to still remain very active in the capital markets. So raising fixed income instruments, debt. So let's say the equity that we are raising currently, up to 30 million euros of primary proceeds, will be further used to borrow, to continue borrowing and continue being present in European capital markets with more and more new bond issuances, refinancing of the current ones. And this is the way how we will get to that 520 million loan portfolio mark in a midterm.
Thank you. All questions are now answered. Modestas, Mari, over to you for the final remarks.
Sure. Actually, we see on the screen that a new question came in. I don't know if we still have time.
Yeah, let's take one last one.
All right, and the question is on when do we expect to refinance our 2026 bond? So our 2026 bond is maturing in October of that year. We expect to start active work on the planning of that bond's refinance activities already in the beginning of next year, or at least in the first half of the next year, with the goal by end of summer to already have a tangible plan in place with potentially already bank syndicate onboarded and with a clear action plan how we would execute that bond refinance exercise.
Thank you. So with this, we're closing the call. Participants, thank you for being with us today. Mari, Modestas, the closing words.
Sure. Closing words are very simple. Thanks everyone who has participated. Thanks for dedicated time. Thanks for very interesting questions. Thank you for you, Nasdaq, that you arranged this. And what we showed today, it's just like a small part of overall information. For more, you can go to ipo.eleving.com and check out our IPO offering. Thank you very much.
Thank you.